All right, hello everyone. My name is Giovanni. Today we're gonna be learning about investment banking. More importantly, this is a very intro to investment banking, to the investment banking world. This is not any sort of like interview prep, nothing like that. This is literally if you are picking up an investment banking book today, or you looked it up on Google or whatever it might be. You want to learn more about the subject. This is what these videos are going to be for you. I'm going to try to keep each one relatively short. Of course, this one might be a little bit longer. It's more of an intro. This is my first time doing anything like this. So let's get into it. We're going to be learning really quickly. The first topic is going to be what is an LBO. So LBO, or leveraged buyout, is actually like a financial transaction in which a company is purchased using like a significant amount of borrowed money. Okay, the idea is that usually it's a private equity firm. They put down a small amount of equity and finances the rest of the purchase price with debt. All right, so the main idea here is debt. So why use so much debt? So the debt itself is often secured by the assets of the company being acquired, which sort of reduces the financial risk for the buyer. So the goal here in these leveraged buyouts is to use the company's cash flows or to sell off parts of the business to repay the debt over time. So you buy it using debt, and then over time you pay back the debt. Ultimately, what you're trying to do is increase the return on equity for the buyer. All right, now let's break down some important concepts you'll need to know, starting with the comparable companies, or comps. So they're a group of business similar in size, industry, or financial performance to the company being valued. Investors will typically use these comps right here. This is a quick definition to gauge the company's value by comparing it to its peers. So it helps understand the market's valuations, price to earnings ratio, or its EBITDA. Or enterprise value to EBITDA. So that's very important. We should write that down. Just enterprise value to EBITDA. Crucial points here. So how this works is it's by looking at previous M&A deals. So previous M&A deals here. Previous M&A deals in the same industry, and analyzing the same terms, valuations of past transactions, so that the investors can determine a fair price for the current deal. Think of it like checking the price of similar houses sold recently when buying a home. These are quick, so I put them all on the same slide. LTM, last 12 months. Okay, you'll need to know this for future videos. It's just a way of measuring a company's financial performance over the most relevant 12-month period. It's used to give just a more accurate, up-to-date view of a company's earnings or revenue trends, smoothing out any seasonal fluctuations. These two, very key terms. No matter where you are in the financial world, if you're going into finance as an industry, you'll need to know this. So these are non-cash expenses. It's important that you know this. Non-cash expenses, okay, that reduce the value of the tangible for depreciation and intangible for amortization. We have it right here. So they reduce the value over time for these assets. For example, if you have machinery and equipment that loses value as they age, which is accounted for through the depreciation right here. Depreciation. Let me get a laser. This one over here. Depreciation. And similarly, if you have intangible assets like patents or patents, they're amortized over their useful life, and that would be right here, intangible assets. So these expenses are important because they impact the company's profitability and, most importantly, for its tax calculations. Okay. Now, lastly, very basic term, literally in the name, is cost of goods sold. Why is this important? Because this represents the direct costs associated with the production of goods sold by a company, including material and labor. So this is subtracted from the revenue to calculate gross profit. And again, so we should write that down, gross profit. Very key term here. You should probably look it up if you don't know what this means, but I'm not going to have enough time to explain every little detail here. But understanding COGS is essential COGS, or cost of goods sold, is essential because it directly affects the company's profitability. So why do these terms matter in an LBO? Let's do this really quickly. Why do they matter? Because they play such a crucial role in determining. Oh, one more time. Determining the value of the target company. All right. So the target company and then the structure of the deal. For example, comparable companies and precedent transactions help assess what price to pay. Well, the last 12 months figures are like those numbers in the last 12 months are crucial in evaluating the company's recent performance. So then you have depreciation and amortization, which affect cash flow, which is key for paying off the debt in an LBO, and COGS impacts the overall profitability. So I hope this gives you more of a clear understanding of what an LBO is and some of the essential terms you'll come across as we go through these terms and just trying to understand what investment banking is with valuations, leverage buyouts, and how it relates to the M&A world. So please let me know, drop a comment, let me know how I can improve these videos. We'll see you in the next one. Thanks.